Yeah, Julia, the Nasdaq 100 has really been at the kind of the point of the spear in the expansion of valuations of the market overall. Still well above pre-pandemic levels in terms of Nasdaq 100 forward price earnings ratio. For example, we got up to 30. It was around low 20s before that, now down to about 27. This is a 2-year chart, though, and it shows you we're a little bit of a significant point in this thing. If you go to around the election, the 2020 election, that's basically your line. You could connect all those different lows, all the different pullbacks, more or less gathered themselves up around that level. Some technical analysts are pointing out that it's around the 150-day moving average. It's not a very commonly watched thing. But the point being, there has been this steady uptrend. We're testing it right now. It hasn't lost at all. But if, in fact, it is a longer-term valuation adjustment, if it's going to be a complete mean reversion, there's probably more to go. If not, if we're at a higher level of valuations for these higher quality businesses and the overall stock market for various reasons, negative real yields or any of the rest, then, in fact, maybe things can kind of get their footing before that happens. Also want to point out, remember what happened. That's the COVID crash there. But you also had a period from September to January, September of 2020 into January of 2021 and beyond, where, the Nasdaq 100 didn't do a whole lot. So we'll see if this is just another kind of step back to let the rest of the market come to the fore, or if it's a little more of a consequential decline in this leading area, guys.
Mike, historically, how long do these tests usually take to proctor?
I don't know if there's a real good rule on that. I would say multiple weeks. It would be a typical way that a routine pullback / correction would really play out. Difficult to say if that's all we're in right now. That's part of the tricky part. Is that a correction looks a whole lot like the beginning of a bear market. And so it's not as if there's a way to say that we can set the clock on it. But yeah, I would say multiple weeks, high single-digit declines has been just about the rule, at least for the last year and a half, 2 years.
Mike, I was talking with Dan Niles, a frequent guest, on a live stream earlier this week about the Nasdaq's fall, and he was sort of making a similar argument, but saying that based on history, and he looked all the way back to the dot-com boom, that we could see the Nasdaq drop 20% plus or more. But the composition was much different back then, right? And I think that's important to know, even though when we talk about these high-growth companies, they're real companies with real earnings, even if that's further off in the future.
Exactly. Now, there were certainly, I would say, if you looked at the top 5 of the NASDAQ back at the peak in the year 2000, also real companies. We're talking about Microsoft, Intel, Cisco, and such. But they were just valued so much more highly. I mean, I don't think the most expensive of the big ones right now is Amazon based on earnings. And pretty much all of the NASDAQ stocks were above 50 times back then, which is where Amazon roughly is. So, yeah, there's a certain difference in terms of the level of maturity and at least arguably the level of predictability. But another factor here is we have had this situation where the market as a whole became very concentrated. We know that. Earnings are concentrated, revenues are concentrated, and stock market weightings were very concentrated. If that's going to spill in reverse, there's no real kind of drawing a line to say when that's over. Because you do, as I mentioned earlier, Apple and Microsoft are more than 13% of the S&P right now. Nothing says they have to stay at that big a weighting.
And I do wonder how leverage, options, and crypto might play into all of that as we forge ahead, Mike. Thank you.
Yeah.